If you have been wondering, how do I start investing in mutual funds in India? And you always keep wondering, where do I start? How do I start? You're not alone. How do you start mutual fund investing in India? I'm going to give you a step-by-step guide for beginners. Hi, Namaste. My name is Taresh Bhatia. I am a CFP, Certified Financial Planner. And you are wondering, what are the steps to get started in India for investing in mutual funds? The easy way, not do it yourself. Whether you are a salaried professional or a young couple or just starting your financial journey, today I'll make you go through a very simple, clear, step-by-step process so that you can start your first mutual fund investment confidently, without confusion or costly mistakes. Stay with me till the end because I will also share my bonus pro tip that has helped hundreds of my clients grow their wealth safely while avoiding the common traps beginners fall into. Section 1. Understand what a mutual fund is. Easy, fastest way. A mutual fund is a pool of money collected from investors like you, invested by or managed by professional fund managers in stocks, bonds, and other securities. Think of it like a cricket team. You contribute your skills, your money, and the captain, the fund manager, decides the strategy to win the match, grow your wealth. For beginners in India, mutual funds are the easiest way to start participating in the growth of India economy without having to pick individual stocks themselves. Step 2. Define your goals clearly before you start investing. Never invest without a goal. How? Ask yourself, am I investing for retirement? Am I investing for my child's education? To buy a house in 10 years? Why? Why? Because your goal decides which type of mutual fund you should be picking up. For what tenure? Whether it's short-term goal, short-term tenure. You may need a debt fund. Whether it's a long-term goal, wealth creation, may need obviously equity mutual funds. So decide the goal and the tenure and the risk profile. Number 3, complete your KYC. In India, you cannot invest in mutual funds without completing your KYC. Know your customer. Simplified. There are step-by-step processes, one-time process to go through to create your CKYC using CAMS, KFintech or MF Central. You need your PAN, Aadhaar, photo and bank details, address proof to get started. Once this is done, you're ready to start investing without any other further help. KYC done. Step 3. Step 4. Choosing the right mutual funds. That's a tricky part. For beginners, I would recommend, would you like to start with index funds? Because you can track the Nifty, the Sensex, invest in large cap equity mutual funds, investing in big mutual fund stocks as such, aggressive hybrid funds, mix of equity or debt. Step number 4 is you need to understand your risk appetite. What is a risk appetite? How do you find it? There are very simple tests. On my website, I have a risk appetite test. Go through tareshbhatia.com and understand, take up the risk appetite test. What is risk appetite and why is it important? How does it help you? Why is it critical? Unless you know you are a conservative investor and a balanced investor or an aggressive investor, how will you choose which kind of fund? Let me help you. For conservative investors, there could be debt funds. For balanced kind of not equity, not debt, but who are not conservative, who are not very aggressive, becomes a balanced category or midway. And the third one is aggressive. And aggressive has got another 11 steps, 11 categories. To make it more simplified, the first 3 steps which I said also help you. Your goals, your time horizon, and now your risk appetite. These 3 factors come very important when you're deciding which category of mutual funds to invest in. The fourth could also be consulting a mutual fund distributor or a financial planner will help you to understand all of this in a very simplified manner, because he will take you through 1, 2, 3 steps tell you your risk appetite through a risk appetite test, and tell you these are the 1, 2, or 3 fund categories to invest in. He will review, he will monitor, he will tell you when to start, when to end, when to change the fund, whether it's doing good or not, whether to withdraw, whether to redeem, or whether to continue. Whether that SIP is good enough for 3 months, 6 months, cannot continue for 20 years. So it needs reviews, it needs a professional, like a driver, like a pilot in an airlines who knows how to take off, land, when to be in the air, when there's turbulence, what exactly to do, tell you, fasten your seat belts, stay calm. The weather is going to be tough and rough. So likewise, your financial planner or mutual fund distributor will tell you, stay put. This is turbulence. And the other side is fine weather outside. Look outside. Beautiful view. Enjoy the journey. Likewise here in mutual funds, you cannot pick up, let me pick up a large cap fund, or let me pick up a equity fund of which performed very good in the last 1 year. So taking the help at this moment, at this step from a professional does help you, and obviously saves money in the short and the long run also. The fifth step, I would say, after you've understood which category of funds and how do you get started with your mutual funds, you have to decide whether you want to do a lump sum investment or you want to start with a monthly or a quarterly or annual investment. Deciding. So SIP, a monthly systematic investment plan, lets you invest a fixed amount every month by giving instructions to your bank that I want to invest every month, and this helps you average out the market ups and downs every time, every month. A lump sum in one go, in one in time investment for most beginners helps to get started. For other beginners, a SIP is the easiest way, the best way, because it builds discipline and removes the stress of trying to time the market. Market is high, market is low. The sixth step is choosing your investment platform. Where do you invest through? You could invest through the mutual fund website called the AMC website for the reasons you choose as convenience, or some app. And if you want expert guidance, work with a certified financial planner like me so that your investments align with your goals, time horizon, risk profile. Number 7 step, monitor. But don't overreact. Your professional CFP has to check your portfolio every 6 or 12 months, not every day. Focus on whether your fund is meeting your goal, not just beating the market every week. Tip number 8, reinvest your gains as advised by your professional. Increasing your SIP annually by 10% as your salary increases beats inflation and increases your investment. That's a secret tip for compounding wealth in India. Now, if you found this useful, to get started, hit like, share with your friends, subscribe for more Indian personalized financial strategies. If you want a personalized mutual fund plan, connect with me. Go to the site tareshbhatia.com. Learn how to get started and I'll help you to get started and protect your investments also. If you like this video, do share and subscribe. This is Taresh, your certified financial planner, with you creating your wealth the best Indian way, personalized. Thank you.